and help you pick the right stock at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Brace for impact. Well, let's go straight to the headlines. Global markets falter as investors assess the impact of higher interest rates and the trade war on earnings. Minutes of the Federal Open Market Committee meeting indicate that interest rates may rise even higher than long-term estimates. Reliance will buy controlling stakes in Den Networks and Hathway Cable for a sum total of over 5,200 crore rupees. A strong performance of its petrochemical operations offset the weakness in Reliance Industries' refining business in the second quarter. Jio continued to grow at the cost of ARPUs. And rising costs may hurt UltraTech's numbers in the second quarter, even as volumes are expected to see a sharp rise. Okay, let's take a look at the trade setup for the day. Firstly, what the FOMC, let's take a look at the news around the world, essentially. The minutes from the FOMC that came out late last evening or in trade yesterday certainly seem to indicate that there is a more hawkish Fed than what the street would have thought otherwise, because the interest rates will have to rise high enough to slow down the economy is something that they are saying. Now, this, I normally wouldn't set the cat amongst the pigeons, because a lot of informed investors were already bracing themselves for a pace higher than what the Fed was earlier estimating because of the wage growth in the US and the resulting inflation that it would bring along with it. Now that the Fed has officially put it out, I think the street would believe that there could be a faster pace. And coupled with the global uncertainty around trade wars, it's a perfect recipe for the markets to be cautious, if not get beaten on out of shape. But select markets did get beaten down out of shape in trade yesterday. So Asian markets, and particularly China, was down and out. I mean, markets faced a lot of turbulence. The yuan continued to fall, and that it was trading at the lowest levels in the last 2 or 3 years. This is what's happened in the session today, but the Chinese markets in trade yesterday fell about 3%. Mind you, the US markets taking off from where the Chinese markets left off. China proved to be a bit of a lead indicator of sorts, and it was the second day of a fall for the US markets as well. So just bring up all the world markets now, at the US markets as they shut yesterday, and the Asian markets as they're trading right now, and you will see that there was a fair bit of pressure. Nasdaq was down 2%, S&P 500 1.5% down yesterday, second day of fall. China, after falling 3% in trade yesterday, you will see that there's some falls in today's session as well across the board. So Nikkei down about 1.25%, Shanghai about 0.8%, Hang Seng would be down too, and the SGX Nifty, I dare say, is right now pointing only towards a 62-point downtick. But with a day's holiday behind us, I would suspect that there could be some further corrections post-open as well. So there should be some issues. Meanwhile, the statements that are coming in between the US and China are not helping matters either. Trade tensions right in the air. And Kudlow mentioned that while Trump will meet with Xi Jinping in Argentina next month, they believe that China doesn't want a deal because China has not responded positively to any of their asks in the US trade talks. So that is something that will not help sentiment either. Now, how does all of this rub into India? We've already shown you the SGX Nifty, and that will correct. But even irrespective of what happens today, remember 3 sessions ago, we were talking about the Nifty, or rather on Wednesday early morning session, we were talking about the Nifty approaching the 200-day moving average from below and might find resistance there. Now, it did find resistance because in Wednesday's session, we did correct quite a bit. And that correction might only continue looking at the global markets. The broader markets in Wednesday's session cracked even harder. The market breadth was abysmal, both as an overall market cap and especially in the small cap space. So there's a fair bit of selling that we saw, but for the fact that the fund flows weren't the most terrible. Second day in the last 3 days that we've had some positive flows by FIs. It's not a big number, but the fact is that it's not an over 1,000 crore negative number, which might be good news, but let's see how long does this last. Frankly, I wouldn't read too much into it. But let's try and tell you what are the stocks to monitor today before we get you big global voices, because I think global is the news or the need for the hour. One, watch out for the Nifty results. UltraTech Cement comes out with numbers today in line with what ACC has done. You would suspect that UltraTech would be a key number to watch out for. And some stocks that might react at 9 a.m. today. Yes Bank, RBI has denied request for extension of Rana Kapoor's term. Stock was anyways down about 7% in trade. Likely to correct a little bit further in the session. Jet Airways, PTI is reporting that Tata Sons is mulling acquiring stake in the beleaguered airline. Let's see if there is a bit of a positive reaction on Jet Airways to that. Was down just about 1% in trade yesterday. Den and Hathway, is it a case of buy the rumor, sell the news? Or would people be enthused that the deal has finally happened? And would we see some further buying here? The buyback price or the open offer price that Reliance will have to give for a Hathway, for example, higher than the current market price. Let's see in a market scenario this whether they react or no. And in terms of numbers, the one set of numbers that I thought stood out on the positive side was Cyient. Revenues up 9.9%, margins at 10.4 versus 8.8%. Good show. Let's see if Cyient reacts or no. And ACC likely will react negatively. However, let's tell you what's lined up on First Word today. We discussed the continued sell-off in global markets with Ken Wong of Eastspring Investments. What does the Den and Hathway acquisition offer Reliance? Sameet Sarkar tells us all about that and the performance of its current businesses as well. UltraTech's realizations may drop despite the double-digit volume growth. Nikki Mirchandani joins us with the earnings expectations. And lastly, has the recent market correction made premium stocks more attractive? Darshan Mehta weighs in on that. Okay, let's start off with the big news that came in post-market hours on Wednesday. After turning the wireless telecom industry upside down, Mukesh Ambani now eyes broadband and direct-to-home TV services. Reliance Industries will acquire controlling stakes in Den Networks and Hathway Cable for a total investment of 5,200 crores. Sameet Sarkar is standing by with the deal contours and why it makes sense for Reliance Industries. Sameet, good morning.
Good morning. So if we see Reliance Industries by spending less than 10% of its total cash reserves will be acquiring stake in two major cable and broadband service providers. Now if you see the deal structure here, in Hathway Cable they will be acquiring close to 51% stake for close to 2,940 crore rupees by acquiring new shares, and in Den Networks they will be acquiring nearly 66% stake for close to 2,290 crore rupees by acquiring the stake from promoters and by subscribing to new shares. Now because of these two acquisitions, the company will also have to make an open offer to the existing public shareholders of four companies, that is Den Networks, Hathway Cable, GTPL Hathway and Hathway Bhavani. Now Hathway Cable owns nearly 37% stake in GTPL Hathway and it owns close to 51% stake in Hathway Bhavani, and that is the reason why it has to also make an open offer for these two companies. So that's how the open offer is structured. Now what does Reliance Industries get from this deal? Well, this deal will accelerate Reliance Jio's entry into the home broadband space. That is a new venture that Reliance Industries has now entered into. So Hathway Cable has nearly 72 lakh subscribers on the cable business and then has close to 72 lakh subscribers for the cable business. So Reliance Industries will get close to 1.4 crore cable subscribers and close to 8 to 9 lakh broadband subscribers. That is what Hathway and then has. Now along with this deal will also give Reliance Industries the last mile connectivity, which is one of the biggest hurdle when it comes to the cable and the broadband industry. So that issue gets solved by acquiring these two companies, and with acquiring these two companies it also gets a ready distribution network of close to 27,000 local cable operators. So this is the two important things that Reliance Industries gets from this deal. Now whom will this deal impact the most? Well, it will impact the existing DTH and the broadband subscribers. Now if you see the DTH market, now that has seen a steady subscriber growth over the last 5 quarters, and if you see the market, there are only 5 players in this market, and the top 3 players, that is Dish TV, Tata Sky and Airtel, they control nearly 88% of the market. So these 3 players will be vulnerable because of this acquisition that Reliance Industries has done. Now along with this, now if you see the broadband segment, now the subscriber base growth there was a bit sluggish. In fact, it has come down in the last 15 months when it comes to the broadband segment. And in the broadband segment, there are major 5 players, and the top 3 players, that is BSNL, Airtel and ACT, which is Atria Convergence Technologies. Now these 3 players control more than 80% of the market share. So these 3 players will also see some pressure going forward because of this acquisition that Reliance Industries has done.
Okay, so let's talk about Reliance's existing businesses also, Sameet. How did the oil and gas to telecom conglomerate perform in the second quarter?
Well, the numbers are largely in line both for Reliance Industries, the standalone business, and for Reliance Jio. Now, for standalone business, yet again, it was the petrochemical segment which stood out for Reliance Industries. Now, the petrochemical business benefited because of higher demand, while the refining business remains subdued due to plant shutdown. Now, if you see the refining business of Reliance Industries, that has been subdued for the last 5 quarters. In fact, if you see the EBIT margin of Reliance Industries refining business, that has declined for the last 5 consecutive quarters. However, in the second quarter of financial year 2019, it has declined at a slower rate. It has declined only by 17 basis points compared to the first quarter of financial year 2019. Now, because of this planned shutdown, the company's gross refining margin were also under pressure despite a stable benchmark. Now, if you see Reliance Industries gross refining margins premium to the Asian benchmark, that is the Singapore gross refining margin, that has come down to around $3.4, which is the lowest in the last 10 months which Reliance Industries has seen. Now, the Singapore gross refining margin was stable at close to $6.1 per barrel, but its premium has come down to $3.4. So there was some pressure seen here also. However, on the positive side, the retail business, now that stood out again for Reliance Industries in this quarter. In fact, the EBIT of retail business for Reliance Industries has grown more than 250% for the 3rd consecutive quarter, and in the second quarter it has grown 272% compared to last year. So this was a positive thing for Reliance Industries. Now comes the telecom business. Now the telecom business was purely aided by subscriber addition. Now if you see in the second quarter, the company added nearly 3.7 crore subscribers. That is the highest quarterly addition seen by the company in the last 5 quarters. Now this has come at the cost of the ARPU. Now if you see the company's average revenue per user, now that has declined continuously from 156 that the company reported last year. It has now come down to 132 rupees per user, and it reported 135 rupees per user in the last quarter, and now it is in the second quarter it reported close to 132 rupees. So the subscriber additions have impacted the ARPUs of the company. Now, if you see the companies on the operational side, the company's capital expenditure, now that's continued to remain on an elevated level. In the second quarter, it stood at around 16,000 crore rupees. And for the first half of financial year 2019, the total capital expenditure done by the telecom business was close to 33,000 crore rupees. Lastly, few key important points when it comes to Reliance Jio's earnings. The company's total debt, now that has come down to 84,000 crore rupees from 92,000 crore rupees. The churn rate, that is the attrition rate, now that has spiked up to 0.7% in the second quarter from 0.3% reported by the company in the last quarter. However, this rate of 0.7% is way below the industry average. Lastly, the data consumption, now that has marginally increased to 11 GB per user per month from 10.6 GB reported by the company in the last quarter.
Okay, Sameet, thanks for putting that into perspective. So Reliance Industries met estimates, may not have too much of a reaction. Let's see if Den and Hathway have some reactions. Another company that came out with its earnings on Wednesday was ACC. The cement maker failed to meet estimates, however, despite volumes rising by 10% on a year-on-year basis. Revenues came in at about 3,364 crores and net profit was up nearly 16%, but lower than Bloomberg estimates. Higher costs dented margins, which fell below 13%. I think realizations were the key problem for ACC. It was essentially weak realizations which dragged earnings. And is that a lead indicator what some of the other cement companies could do? Well, let's pose that question to Nikki as well, because all eyes will be now on peer UltraTech, because that's the country's largest player, which may see its realizations drop as well in the 3 months ending September. Nikki, would ACC's earnings be a lead indicator for the other cement companies, particularly UltraTech?
Well, ACC and Ambuja were expected to be the only companies reporting good set of numbers. Clearly, we've seen disappointment creeping in from ACC. UltraTech, we're not expecting a great quarter either, a subdued quarter in offing. Let's look at the revenue growth out there. We're looking at a 20% uptick there to a number of around 7,873 crore. If you look at the EBITDA performance, we are expecting a flattish trend there, a 2% downtick to a number of 1,328 crore. Margins are expected to contract to 17% as compared to 21% seen in the corresponding quarter of the previous year. Profitability too is expected to go down by as much as 3% for this counter. Key parameters that we like to keep an eye out will be the volume figure, which is expected to see an uptick of nearly 22% YOY basis to a number of 16 million ton. EBITDA per ton, now that's expected to go down by 19% to a number of less than ₹1,000. Realization per ton also expected to be flattish. This is the kind of trend that we've already seen in ACC. What goes behind the making of these numbers? Volume are expected to rise on account of newly acquired acquired assets of JP Group. On account of that, we will see the volume push coming in from UltraTech Cement, which is in turn going to be reflecting in the top line performance of the company. Realization are expected to be muted given the kind of trend that we've seen in northern and southern region, which is expected to offset the kind of hike that we've already witnessed in central region. Higher energy and freight costs are expected to weigh down on the operational front of the company. Key parameters that we like to keep an eye out, apart from the volume growth figure, will be the outlook on the cement prices, the input pressures commentary, and also the update on JPA operations in terms of the capacity utilization of the newly acquired assets. Back to you.
Okay, Nikki, many thanks. We'll watch out for this. Now, the next two pieces on First Word are all about markets. First, an opinion on what's happening in the Asian markets, and then Darshan Johnson to talk about what the valuations of some of the Indian stocks and the premium stocks would be. But call it the ripple effect or domestic factors, global equities have been faltering the world over, and nothing seems to be giving investors any comfort. Common link in the Asian markets is a call on liquidity, be it China or Asia, despite the respective central banks trying to assure investors. So what's keeping investors on tenterhooks? Let's pose that question to Ken Wong. He's Asia Equity Portfolio Specialist at Eastspring Investments, joins us right now for a quick word. Ken, good morning to you. Thanks so much for joining in. China fell very hard yesterday. The fall seems to be continuing in the session today, though I must say Shanghai has recovered from the early morning lows and is trading marginally in the green. How are you looking at the sentiment in the Asian region?
Yeah, I mean, obviously, sentiment right now is somewhat negative, and obviously, I think right now what you're seeing is that there are some investors who are right now looking at some bottom fishing, because in particular, you look at the markets. Yes, they did open, slightly negative this morning, but then over the past 30 minutes or so, we definitely have seen a bit of a rebound, especially when you look at some of the financials, some of the banks, some of the insurance companies, some of the property names in China. Those have definitely recovered a bit. Tech names, yes, still have ways to go, but I think right now what you're seeing is definitely a bit of bottom fishing, especially when markets now are trading below 10 times earnings again.
Ken, one thing is Shanghai, which is probably trading at the lowest level since 2014, and that may see some bottom fishing. But the Fed commentary and the stress around crude prices, do you reckon that there is more downside at large for EM and Asian equities?
Yeah, markets will definitely remain volatile over the next 6 weeks or so. I mean, there's a couple of key events that that potentially could impact markets, quite a bit. Obviously, we do have the midterm elections in the U.S. coming up in a few weeks' time. And then we also have the G20 summit that's happening at the end of November, and most likely where President Xi as well as President Trump will meet. So I think before those events, you will continue to see a bit more volatility as there continues to be more uncertainty over, what's likely to come, sort of in the coming months.
Okay. Lastly, Ken, I don't know how closely you track India, but Indian markets have come off a little bit from the levels that they were trading at. If indeed this meltdown, if I can use that term, in the Asian markets and China continues, do you reckon lower levels for a market like India are also possible?
Potentially, but at the same time, I think, sort of when you look at it, you have had a bit of a correction in Indian markets, already, and obviously with the elections coming up next year, there potentially could be some opportunities as well. Again, but you have to take, sort of your specific areas. You're not going to be in the markets completely, but there are, I think, specific pockets where some of the stocks do continue to be looking interesting again, especially with the correction that we've seen over the past month or so.
Ken Wong, really appreciate you taking on the time this early in the morning on this late-minute request. Thank you so much, and thanks for speaking to us today. Well, that's the word from Eastspring Investments, some bottom fishing. Speaking of bottom fishing, just pull up the Shanghai markets, and that's the green on the screen that I'm talking about. Was trading about 0.25% or 0.5% lower, and now marginally in the green is Shanghai. Early days as yet to call it a bottom of sorts, but some bit of green for Shanghai after the bad day in trade yesterday. But speaking of bottom fishing, speaking of market corrections and premium stocks correcting, this recent market correction in Indian markets has given a reality check, especially when it comes to valuations of some of the investor favorite stocks. But have they corrected enough to provide attractive entry points? Darshan is here to tell us about the largest stocks by market capitalization that still trade at premium valuations. Darshan. What is the study about?
Yeah, so basically what we did was the Nifty has fallen, a lot of stocks have fallen significantly. So we're determining whether, the valuations still are very, very ripe or they have come down. Now, first of all, what we did was, and just hold on to the screen, what we did was all the stocks in India over the market cap of 500 crores, in which the price earning multiple is above 50 times. So that is something that we sorted out. So there are 32 firms which have a market cap of over 50 times on an FY19 basis, and 9 firms have PE of over 100 times on an FY19 basis. So that's the finding. So a lot of stocks still, despite the correction, are expensive. So that's something that we have. Now what we did was we sorted them by market cap, because those are the regular ones with heavy volumes, with large revenues, large earnings, because some of the companies, the PE ratio will be slightly skewed, or some of them won't be using the PE ratio because it's a better on an EV EBITDA multiple, or banks don't come in because they have a price to book worry. So the companies that use a PE multiple, those are the companies that we have shortlisted, and that we did it according to market capitalization. Now pull up the first stock that we want to talk about, and that is Hindustan Unilever. Now the FY19 PE estimate is 53 times, so that's the estimate. It's fallen almost 13% from an all-time high. The FY20 is almost 46 times. So from a peak forward earnings of 63 times, HUL has already corrected to almost 53 times, but it's still way beyond the 41 times 5-year average that it was. So it's not something that, and HUL is one of the stocks in the FMCG index which hasn't corrected that much as the other peers. So HUL still on the expensive side, despite the correction that is there. HUL still continues to be on the higher side, and the premium valuation according to the street is because of the distribution reach it has, because of the execution it has, because of the MNC parentage that it has. So those are the factors that the HUL gives, and it's one of the most expensive consumer stocks that is there. What are the analysts saying on HUL at this point of time? The potential upside is still 9%, and this comes after a 13% correction. So it was overvalued. Still, majority of the street believes that HUL, they have a buy recommendation, but the risk upside potential is just 9% as per the Bloomberg consensus estimate. The second stock that we want to talk about, and basically this list is mainly on FMCG stocks, because they are the ones that have actually moved up in consumer stocks. Now if you're looking at Avenue Supermarts, the FY19 estimate is 80 times, FY20 is 60 times. It's come off significantly from the peak forward earnings of almost 113 times, but we took the 1-year average because it recently got listed. It's trading pretty much at the same time. It's corrected almost 20% from the all-time high, but valuations by no means are cheap for Avenue Supermarts. Let's take a look at the Bloomberg consensus estimates, what they're saying. Still, the return potential is just 3% after a 20% correction. So most of them had a negative view. Majority of the view is of a negative view. On 60% of the analysts believe that Avenue Supermarts still is a sell. The third stock that we want to talk about in this space is Britannia. Again, FMCG stock, FY19 estimates of 55 times, FY20 estimates of 45 times. It's come off the peak valuations of 70 times, but still more expensive than the 5-year average of 38 times that we've seen. So despite a 20% correction, still continues to be much expensive than what its average was. Still, but the consistency is that most of the analysts, 64%, believe that Britannia is a buy, and the potential upside that they believe is 16%. So that's what the street is saying, but valuations still compared to the historical average are much more expensive. The next stock that we want to talk about, again from the consumption is United Spirits. This one has corrected 33%, and it's not only valuation, there are other reasons why United Spirits faced issues in terms of the rules and regulations, in terms of the other issues. The FY19 estimate is 53 times, FY20 is 41 times. It's come off the peak valuations of 130 times and trading below the 5-year average of 61 times. So that this one in fact has now gone, one of the only stocks that has gone below the 5-year average that is there. In terms of what the analysts are saying, pretty much even Stevens is something that they say, and the return potential is 11%. Now United Spirits is the largest spirit company in India. They get the premium valuation because of the MNC parentage of Diageo, the distribution, the reach, the premium products that it offers. And finally, the last stock we want to talk about is Biocon. FY19 estimates of 63 times because of earnings that will go up. FY20 is 37 times. It's pretty much trading near the peak forward, but the 5-year average is 29 times. So much more expensive than what it was on a 5-year basis. It's fallen almost 12%, and the niche opportunity that it offers in terms of the biosimilar pipeline is something that a lot of analysts have come out. It's, as far as the street is concerned, it's pretty much a consensus buy. 60% have a buy, but the return potential is absolutely nothing even at these valuations. Majority of them don't believe that the earnings potential is there. So counters, brokerages like CLSA and Kotak don't have the positive rate on Biocon. But still, a lot of other notable mentions include counters like Page Industries, United Breweries. All these are expensive stock, but we took the 5 according to market cap.
Very interesting. This will make for a really good read as well, but later on the side. Darshan, thanks for putting this into perspective. Well, just before we end, first, what a couple of news bits. One, remember the US Treasury Department report is saying that India may be removed from a currency watch list because India's situation has changed markedly, with net purchases of foreign exchange down to over 0.2% of GDP from 4 quarters behind. So that's a small bit of positive news. The other piece of news that I just want to highlight before we take that break is this news story about the NSS, the cash trap, rather NSS, this National Small Savings Fund, giving Air India 1,000 crore odd lifeline. Now, lots of chatter in social media about whether this is a right move or a wrong, and frankly, need to read in the contours of the deal. But the government has now been depending on this for some time now. There's an increased reliance towards the small savings schemes from the government of India's side as well. A lot of something on this will be during the course of the day put up as well. But just a couple of news bits that I thought are important and viewers should know about. But that's all that we have on First Word today. But lots more coming up on Indian Open. Right after this break, we talk to HSBC's Bill Maldonado on the global sell-off and what's making investors nervous. Then the grocery space in India is undergoing a transformation, especially with online players like Amazon, Pantry and Big Basket making their mark. So what does it mean for incumbents like Future Retail? We speak to Rakesh Biyani at about 9:35 odd today. And of course, a conversation with Harsha Upadhyaya from Kotak AMC as well. But for now, take a break. Full tilt towards the day straight on the other side.
Good news, got a promotion and a damn good raise.
Congrats, beta.
वाह, raise? अब तो insurance policy ले ले.
कौन सी कंपनी से लूं?
Choose वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. about going all in. Coming, Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. A quick look at what's been happening in the Asian markets. Remember, we've been talking about the turnaround in the Chinese market from being down closer to 0.5% to now being up 0.5%. So Shanghai is trading in the green, Nikkei is down about 1%, and Hang Seng trades absolutely flat. No marginal gains or losses, no gains or losses there. But something more interesting to talk about in terms of the overall sell-off that's been happening across the globe. The last day, yesterday was a holiday for our markets, but you did have trades going on in the Asian pack as well as US, which did see a slight bit of a sell-off. And what are the implications of this sell-off in the global equity markets for a country like India, as well as the overall growth outlook for the global economy? Let's go and ask all of these questions to Bill Maldonado. He's the Chief Investment Officer at Asia Pacific region at HSBC Global Asset Management. Bill, thanks very much for taking out the time and joining us this morning. And I want to start off first with the turnaround that we are seeing and the little bit of nervousness that's coming back into most of the markets, be it the developed markets now in the US, which is seeing a little bit of a turnaround from the top, as well as the pain points within Asia as a region. And how are you reading into the sentiment there?
Well, sentiment has clearly been quite negatively impacted over the last month or two as we've witnessed this correction. And I think using that phrase, talking about sentiment, is the right thing to do here. Because as investors, if we step back from it a little bit, we can see that actually the global economy is doing just fine. Last year we had very strong synchronized global growth with very low inflation. This year we've got slightly weaker growth globally. The US has actually ticked up a bit, but the rest of the world has backed off a shade. And inflation has ticked up a little bit. So we'd say growth isn't quite as fantastic as it was last year, but it's still very, very decent. And I don't think that valuations in equity markets, for example, are particularly stretched. And at the same time, we've got very decent growth in earnings. That's the reason we own equities over the long run, is because we're buying a profitability stream. And if that profitability stream is growing at double-digit rates, as it is across much of the global markets today, then that's a very good thing. So when you look at all of that, you sort of scratch your head a bit and say, well, what's going on? And it's clearly sentiment that's been impacted, I think, principally by two things that have happened. One is that as interest rates have continued to creep up, as the Fed has been very gradually, very slowly hiking rates, investors have begun to think about, well, what might happen if inflation does pick up and rates need to keep going up. And that's kind of worrisome and has impacted sentiment. And then the trade dispute is something that's very difficult to price in. Again, when you look at rationally the pure direct economic impact of the trade dispute, even with tariffs kind of set at very high levels, you don't get a very huge number, certainly not enough to derail the Chinese economy or the US economy or therefore the global economy. So it's back to the uncertainty that it creates and the negative sentiment that creates. So I think that's what we're seeing, and very jittery markets. But as fundamental investors, what we need to do is look through the noise, look through the volatility, and really think about the opportunities that creates. And we would argue that there's a lot of opportunities around at the moment for disciplined fundamental investors if they're prepared to look through this period of volatility.
You know, just to address both the points that you made and to counter question on that. First one on US and the rising interest rates, and also the fact that now you have, you know, the tapering off of liquidity. So will that cause a significant worry going forward? I mean, US has really not seen any big turnaround or any big correction in the last 10 years. So you've been on a continuous ride on the upside. There's been no problems there. But do you see significant concerns around the same in terms of easy and cheap money not being available to the market anymore? And on the other hand, you spoke about China. The early indicators in terms of the kind of you know, numbers that we've been getting in terms of PMI data, the GDP numbers, their export numbers, all seem to be highlighting a slightly more negative undertone.
Okay, so I think there's two very different points there. To address the first one first, in terms of liquidity, if you look at the picture of global liquidity, so you think about all of the central bank balance sheets, not just the Fed, but the ECB, the BOE, the BOJ, everybody put together, liquidity has really not changed much. If you look very, very carefully at that graph, you'd see a tiny notch down as the Fed has begun to shrink its balance sheet. But it's really very difficult to see. So I don't think we can point the finger of blame at liquidity. Liquidity still seems to us to be very ample. So again, it may be that that's impacting sentiment, that people are worrying about it, but in terms of direct economic impact, I don't think that that's the main cause. On China, again, I think it's very easy for us to think about the trade dispute that's capturing a lot of time in the media, column inches in newspapers. It's occupying a lot of discussions around dinner tables and conferences, etc. So it's absolutely top of mind for a lot of people. But actually, I think if you look at what's going on in China, it's more of a domestic story. Again, when you look at the direct consequences of the trade dispute so far, they're actually very, very difficult to detect. Only a very small percentage of Chinese listed companies are impacted directly by the tariffs. And you'd say across the broader economy, there's no real evidence that there's any or very, very minor economic impact. So I think you have to look domestically at what's going on in China. Now, as we know, China is trying to pull off one of the most significant rebalancings of any economy in the history of the modern world. They're going from a very, very long stretch, very successful stretch, 20, 30 years of infrastructure-led growth. That infrastructure was, you know, in large part financed by debt, having to restructure that and rely a lot more on domestic growth, less on infrastructure, more on consumers, and also tried to move up the manufacturing value curve. These are not easy things to do. So I think it's not surprising that we're going to get ebbs and flows in the Chinese economy. And right now, we're probably seeing a little bit of, or we've had this year at times, a little bit of a slowdown, particularly, for example, in the property market. Again, China, I think, has done something that's been very smart, very intelligent, and at times when their economy's been running quite strong, quite hot, rather than conventional fiscal or monetary tightening, what they've been doing is more of a regulatory tightening, trying to take care of some of the pockets in the Chinese economy which were not under oversight of the regulators and which were in danger of creating some imbalances. Sure. And that was very smart. That was a great way to control the growth. Right. And now perhaps we're seeing some of those things bite. Again, I would refer to the property market, which is very important in the Chinese economy. A lot of Chinese GDP derives from the property market. So I think it's smarter, it's better to look at what's going on domestically in China rather than just automatically invoke any trade issues.
Okay. So, Bill, in light of all of this, would you reckon that there is a higher probability of some downside due to sentiment, due to nervousness or a fear of the unknown? Or do you believe that foreign money or global equity chasing money will start finding its way? Because frankly, in a market like India, the last 2 months, FIs have pulled out money from the equity markets lock, stock, barrel.
Yeah, look, I think this is the question. So you're asking an excellent question, but the timing of that is very difficult to really ascertain with any degree of confidence. But that's exactly what it's about. So you know, are people going to continue to be driven by sentiment, or are they going to be persuaded that now that we've had a correction, valuations are looking even more cheap, and with earnings growing on top of that, you know, maybe there's a compelling case. Realistically, I think it's difficult to see sentiment turning around on a dime. I can't imagine that things are going to change very, very, very quickly from a risk aversion, more negative sentiment back to a more risk-seeking sentiment that we had in place for much of last year. But if you wait for the turn, it's usually too late. To take advantage of the opportunities, you usually have to act before it's absolutely clear when the turn is going to come. But I think, yes, to answer your question, I think at some point in the not too distant future, the opportunities will be appetizing enough to lure people back and look at the fundamentals, look at what they're getting, and maybe we'll get a stabilization and a much more positive driven market.
Final question, Bill. If you look at India, and I know you look at India, but if you looked at India closely in the recent past, does India fit the bill of where people like you would put fresh money to work? If not now, then maybe a few percentage points lower.
Yeah, I think overall, yes. Obviously, there's a couple of specific things that are going on in India. One is we've got the election coming up, so everybody's watching the government in the lead up to the election, and it'll be important to see what the response is. So far, so good. I don't think that's been a big problem, but I think investors are going to be very focused on that. And the other one is we've had this NBFC issue unfold in the last month or two. Again, I think investors are very interested to see how that's going to be dealt with. There's kind of spillover effects into the financials in general. And again, investors are very keen to see how that's unfolding. So I don't think that takes away from the fundamental case in India. I think the fundamental case in India is that valuations moved up quite strongly last year. And what now needs to happen is that earnings need to come through. Corporates need to deliver earnings. And by and large, we've been seeing that. And that's great. That's very good for investors. And I think if that happens, then we can continue to see a virtuous circle. So I think there's a positive story there. I think investors are watching, but there's a couple of things that are very specific to India right now.
All right, Bill, we'll leave it at that. Thanks so very much for joining us. Really appreciate you taking out the time and sharing your thoughts and views with us right here on the show. Well, on that note, I'm going to quickly go across to the research team. They're waiting by to talk about specific stocks in news and some numbers that came out post-market hours on Wednesday and the kind of reactions that we'd expected to see. So I'll start off with you, Shraddha, on some stocks and news.
Right. So we just have news flashing on the screens that RBI has eased some norms with respect to lending to NBFCs. So they have eased the liquidity coverage ratio, and they've also said that the single borrower exposure limit for NBFCs stands increased from 10% to 15%. So this should aid at least the non-infra lending financiers, so like housing finance companies. Those will be in focus. That part, you have Yes Bank, which has said that the RBI has not allowed the request for extension of Rana Kapoor's term beyond 31st of January. Negative development for the stock. There are also PTI reports which say that Tata Group is in talks to acquire stake in Jet Airways, so watch out for that name. Additionally, there's also ET report which says that Jet Airways has received 6-7 initial bids for jet privilege sale. That apart, there's another small cap company called Apollo Tricoat Tubes which will be in focus. Now APL Apollo Tubes and its subsidiary will acquire the promoter shares and warrants of Apollo Tricoat Tubes, and that will be at a price of 120 per share. So that's a 10 to 11% discount to the previous closing price. It's a related party transaction and it will cost APL Apollo about 96 crores, but this will also trigger an open offer. So watch out for both those names. And finally, Fortis Healthcare and Religare Enterprises will be in focus, and that's on the back of SEBI's direction to Malvinder and Shivinder Singh and Religare Finvest and also 7 others to repay 403 crores to Fortis Healthcare in 3 months. So let's see how those names also react.
All right. Thanks a lot for that, Shraddha. Agam, some results post-Makras?
Yes, a lot from the mid-cap IT space, and I'm going to start with Mindtree, where the earnings were largely in line with street expectations. We did see revenues move up around 7%, and margins have also expanded to around 13.1%. So both the margins as well as revenues is largely in line. Moving on to Cyient, again, while the numbers seem in line, there is a one-off here. Well, we do have a nearly 10% increase in its revenues, and its margins have come at around 10.4%. Its net profits have risen by as much as 55%. But a big factor in play here is the forex gains, and we have other income of as much as 57 crores as against 17 crores. Moving on to Emphasis, again, we're seeing numbers which are largely in line. What stands out here is that the margins have actually come off at around 16.4% versus 16.6%. And we spoke to the management, and the management in the conference call has also suggested that they're fully hedged, which means there has been no impact of the rupee depreciation on their margins. Finally, coming down to Havells India, again, well, it was a mixed quarter. We did see a rise of as much as 23% when it comes to its top lines, but margins came off quite substantially to 12%, and that's the reason why the profits have risen only by as much as 4.7% at 179 crores, in line with street expectations. So those are just some of those well, earnings that we're also tracking in today's day of trade.
Hey, Agam, thanks a lot for that. Now, to the news that is flashing on your screen, the RBI has just eased some of the liquidity coverage ratio norms. Ira Duggal joins us on the phone line for more on this. Ira, what do you make of this?
They've done two things, Neeraj. Good morning. They've essentially again tried to ease the flow of bank liquidity to NBFCs. So the first thing that they have done is that, and I'm going to explain this, they have said that starting today, which is October 19th, from here on, any incremental lending that you do to NBFCs and housing finance companies, government securities equal to that amount of incremental lending will be available to use as LCR from the SLR bucket. So again, to repeat, any incremental lending a bank does from today until the 31st of December to NBFCs and HFCs, a government security pool which is equivalent to that incremental lending amount will be availed as LCR from the SLR bucket. So essentially, very simply, they're trying to incentivize banks to lend more to NBFCs and HFCs, and they're saying that if you do this, if you go ahead and do this, we are giving you an incentive by allowing you to use that amount from your SLR bucket towards your LCR needs. That's number one. The second thing that they have done, and this is actually going to be probably more important, is that the single borrower exposure limit for NBFCs has been raised from 10% to 15% for non-infrastructure NBFCs. So, you know, a lot of banks had already hit some of the limits on these individual NBFCs, the single borrower limits, and they were using that as a reason to say that we can't lend any further, even if those NBFCs needed money. So by raising it from 10 to 15%, they will ease up the flow again. But this is for non-infrastructure NBFCs in particular. I am not clear whether HFCs are part of this because they haven't specified HFCs. HFCs fall under a separate category. Maybe that is because the HFC regulator, which is the National Housing Bank, would need to meet these single exposure limit norms from their end. But from the RBI's end, these two things have come in today. Again, yet another attempt to ease the flow of liquidity to NBFCs. Just brief mention that liquidity in the system is now comfortable, but clearly going by these measures, it looks like that flow of liquidity from the system to NBFCs is still not happening.
Ira, thanks for that explainer. Really helps. Appreciate you joining in this early in the morning. So that's, of course, I wouldn't call it a lifeline, but one more measure that the RBI has undertaken in order to ease the flow of liquidity for NBFCs. But remember, we don't have clarity of whether this some of the infra NBFCs or HFCs in particular, essentially, will have a similar rule or no. I think that clarity will come in during the course of the day. But should be net positive for NBFCs. The problem, though, I still think that the last couple of days people have been talking about what happens to some of the real estate companies now, because they have not been receiving any kind of money. And I don't think this in any way, while it may still increase the flow of liquidity from RBI to or banks to NBFCs, whether NBFCs will have the gumption to go out and lend to housing companies or real estate companies while a lot of other sectors are and safer sectors are gasping remains the key. So for NBFCs, probably good news, at least the non-infra companies, non-infra NBFCs, but for the others and the borrowing sectors, don't quite know.
Basically the bottom line, which has received the money, and if NBFCs any which ways are circumspect in an environment like this to lend to them.
Yeah. Well, let's talk about all of this. Sharmila Joshi, independent investment advisor, with us on the show as well. In a bit, we'll also get in our technical expert. Sharmila, good morning. Thanks for accommodating this last-minute interview request. NBFC still in the eye of the storm. Wednesday session saw a bit of a pullback. What are you doing here in this pocket?
Well, really nothing, because I think that the kind of concerns that have surfaced on NBFCs and housing finance companies, I think that more than really what is being said, I think the imagined problem and the size of it certainly indicates that perhaps, and you actually really don't know within that basket who is more sort of vulnerable than which company. So I think at this point in time, it just makes better sense to wait and watch. Because very honestly, I think where housing finance is concerned, there was a lot done really in terms of making housing, affordable housing, a much better proposition, etc., and so that they could grow their loan book. But we've really seen that slowdown in the real estate. And in any case, I think there were concerns over the kind of results some of these companies had given. And now with this added thing, I think it just makes sense to just wait a little and let clarity on this emerge. Because I think when there is so much, when you're really in the eye of the storm, the way this whole space has been, it's just best to really watch it for a bit.
All right. Sharmila, what are you doing in terms of playing the market at this juncture? Are you bottom fishing?
Yes, marginally, but not really too much, because, the kind of moves that we are seeing in the market are not really giving you a sense that, yes, market could very well trend much lower from here. So you start buying and you, incrementally buy on lower sides. And, suddenly you see these violent pullbacks up. So yes, I have started buying, but I've stuck to the large cap, not really looked at the mid cap. And even there, I've sort of followed an SIP kind of an approach. And I think if you're a long-term investor, and the kind of people that I advise to, I think it's best to really just take it a little slow just now.
Let's get in quick technical perspectives as well, because the markets are not looking as bad as they were at the start of the show. Two experts, Hadrien Mendonca as well as Sameet Chavan, join in right now for quick perspectives. About 6 minutes to go for the pre-open session to begin. So gentlemen, quick opinion from both of you. Hadrien, let's start off with you. How are you approaching trade today?
Yeah, hi, good morning, Neeraj. So weakness is definitely there. I mean, we're going to open with a gap down once again. And I think, the effort that, the bulls have taken on Monday and Tuesday to gain from where they were, the Wednesday's downfall has actually wiped out, 2 days of gains in a single day, which is not a good thing. That is actually, aided the Nifty to actually form a bearish engulfing pattern. Secondly, the Nifty again failed to surpass its long-term 200-day moving average and reversed from the same. We are seeing weakness definitely is there. I think the stance continues to remain sell on rallies, because what is happening is that every small news that occurs, be it for the NBFCs, for the banks, or whatever the reason is, it's been taken badly, and selling pressure is always seen. So I think rallies towards 10,700 again should be an opportunity to sell, and remaining cautious is something that I would advise.
Sameet, good morning. How are you approaching trade today? Is there a trade that somebody can take on the Nifty which starts off about 0.5% lower?
Good morning, Neeraj. It would be very difficult to give any kind of trade settlement. Last Thursday also, when I was there in this particular show, we were supposed to open more than 200 points low. And that day also, we had a similar view that after such a massive gap down opening, index do not have sufficient or enough strength to trend lower, and that's the reason we saw V-shaped recovery in last 3-4 days. Yes, on the higher side, 10,700, 10,750 remains to be a very strong hurdle. And on Wednesday, after a massive gap up, we did see strong selling pressure coming in at higher levels, and that's the reason we ended somewhere around 10,450. And now today, as SGX Nifty is indicating another 100 points gap down. So after opening with a 100 points gap down, we don't want to get carried away by the moment and will not take short position. We would first cover our short positions in the zone of say 10,300, 10,280. It seems to be a very strong support, and for first half, if index managed to hold this important support level of 10,280, 10,350, then we'll not be surprised to see a relief move in the second half. So at this juncture, we'll avoid, but around 10,280, 10,300, if Nifty manages to hold, then we would certainly go contra long.
Okay, Jaiman, we'll take in your stock ideas. I think let's do them post pre-open because it'll be easier probably to give them then. Let's just get a quick perspective from ASV Krishnan from SBI Caps. He joins us on this liquidity standards and the release that's coming from the Reserve Bank of India. Krishnan, good having you. Thanks so much for joining in. Let me just read it out for you. They're saying that it's been decided with immediate effect that banks will be permitted to reckon government securities held by them up to an amount equal to the incremental outstanding credit to NBFCs and housing finance companies over and above the amount of credit to NBFCs and HFCs outstanding on their books as on October 19th as level 1 HQLA under the fall FALLCR within the mandatory SLR requirement. Now, this is the basic release that has come. How do you view this announcement?
So, I would think any special windows that help the liquidity position for NBFCs, especially also the single borrower exposure norms that have been hiked from 10% to 15%. These are special windows, and I think this is available till 31st of December. Very clearly, it augurs well for NBFCs in an environment where generally there is a risk of trade and money is not being made available to NBFCs in a hurry. So I would think definitely from a sentiment perspective, this was very much needed, maybe, and I would think that the regulator has been alert and agile. As they have mentioned, they are very clearly poised to take certain steps whenever they see the markets reacting in a certain way.
The other thing that they've also done is the single borrower limit for non-intra NBFCs has been increased from 10 to 15%. How big a positive is this according to you?
Which is what I said. I think combined the two, when you add up both of these together, it's definitely a big positive. Hiking the non-infra NBFC limit from 10 to 15% for single borrower exposure would mean that in many cases, say the top 10 or 20 NBFCs or HFCs where you may have started hitting that limit, banks have a little more elbow room now available. So liquidity being made available to the top rated NBFCs will not be a challenge. But I would argue in this environment, anyways, they would not have had a challenge. It's the long tail which generally, struggles to raise money. And this may not help that long tail. This will help the top-rated NBFCs for sure.
Okay. Krishnan, we have about 30 seconds for the markets to kickstart. As a result of this move or the earlier moves, are you now turning sanguine on any of the NBFCs within your coverage?
So yes. On the back of this move as well as the fact that the correction has been fairly steep in some of the better-rated names, we would be looking constructively at some of the housing finance names. Yes.
Wow. Okay. Krishnan, I appreciate you joining us this early in the morning and taking the time and speaking to us. Thanks much for being with us. Well,
it's interesting because Ira just highlighted that they're not yet
she was
clear
saying that
on
she was not completely clear on this, but Krishnan believes that some of these could be benefiting out of this as well. But the pre-open session about to begin.
Yeah, indications are that we'll have a slightly lower start. SGX is down about 0.5%. That's going to be something to watch out for in terms of whether or not we see a bigger gap down open, because we've missed one day of trade already. A few ticks on your screen. I think we should go with the index first. So the Nifty opens lower by about 0.5%, and Sensex is open positive by 1%. But these prices will stabilize in a few moments from now. Yes Bank, a big negative there. The bank has been asked to get a new person at the helm from 1st of February 2019. So no extension for Rana Kapoor there. Stocks down 10%. Indiabulls Housing Finance, after the debacle on Wednesday's session where the stock was down about 13%, looks like it's probably going to have a similar start in today's session. It's about 10% lower in pre-open, but again, these are just pre-open ticks. UltraTech Cement, numbers come out today. Watch out for that one. 3% lower. Lupin is the other one, 2.5% lower. Infosys is down 2%. Hindalco, 2% under, 223 on the stock. Reliance Industries is opened lower in the session, closer to 1%. And then obviously we should highlight how Den and Hathway have opened up as well. But HCL Tech, HDFC Bank, Coal India, L&T are all trading under in the session right now. In terms of gainers on the index, Titan is up 2.2%, Bharti Infratel is up 2%, ONGC and the oil marketing boys BP, HP, IOC are up 1.2%. Tata Steel has moved up another 0.5%. So on the Nifty, at least it looks slightly more even Steven in terms of the advances versus the declines as well. But I guess the broader market will show you a different picture.
Yes, it is. Just before I go to the broader markets though, pull up the bond yields and just see if the bond yields have hardened a bit on the back of the FOMC minutes. No, not quite. The yield is okay. The rupee too has not really moved around too much, I reckon, if I'm not wrong. Yes, very, very flat. So no big changes on the macro indicators, but the broader markets now. Mindtree, I doubt it'll be a 10% downtick, but yeah, the numbers just about in line. And we've seen what's happened to companies which just about managed to post in line. Happened with TCS, happened with HUL. Let's wait and watch if Mindtree has a weak start. I doubt it'll be a 10% downtick. But some of the others, Diwan Housing looks like it'll start off on a weak footing. So watch out for that one. The usual suspects of 8K Miles, Bombay Dyeing, Wakrangi, etc. are all down. So no point even mentioning them, but they're all down in trade today. Yes Bank, maybe not quite a 10%, but remember, fallen 6% in Wednesday's session and might have a slightly weak start, though has recovered almost all of that lost ground. Wonder what an Edelweiss and some of the others are up to as well, because those were getting pummeled in trade and Wednesday session, likely to start off slightly weak. What's doing well? Let's talk about the positives also. There are positives. Hathway and Den, you wouldn't have been surprised with this. They're looking like starting off on a good note. Den Networks in particular, for now showing a 19% uptick. This may change a bit, but the stocks could well start off on a positive note. DCB Bank, after the numbers, up about, likely to start off well. And Cyan, on the back of what I thought was reasonably good numbers, likely to start off well. The last stock in news that I want to talk is Jet Airways. PTI reports that Tata Sons may be interested in buying a stake in Jet Airways. The stock ended flattish on a day when almost everything else cracked in Wednesday's session, and looks like starting off on a positive note. So that's too, not doing all that poorly. As we speak, the first 3 minutes though, the Sensex is actually showing a tick marginally in the green. It may well change, but I'm just telling you that it's all over the place right now for some of these names. Okay, let's probably get in some thoughts out here. Sharmila, I don't know if you look at the results that have come out, but one question to you: DCB Bank or a Cyient or maybe a Hathway and a Den which are in news, would you be enthused to buy any of these names on the back of results or on the back of the news?
Probably DCB Bank. I think that could be looked at, and maybe Cyient. I don't think the numbers are out yet, right? So I think those you need to wait for, because I think IT's had a fairly decent performance so far. So let's wait and see what happens there. And I think DCB Bank, because I think now with the kind of news flow that we've had around private banks over these last 3-4 months, perhaps there would be like 2 or 3 names that you could sort of look at. IndusInd Bank being one, DCB could be another, and of course HDFC Bank. So I think it sort of stands to reason that if the numbers are decent, you could see some buying emerge there. So I think yes, DCB Bank could be an interesting stock.
All right, that's DCB Bank, which is open positive by about 5%. Our technical guest is still here with us, so let's quickly run through their ideas for the day. I'll start off with you, Sameet. What are you recommending?
See, we have two buy recommendations. As I said, after a gap down opening, we would rather wait for some kind of prices to stabilize, and at low levels we'll go contra long. MCX certainly looks good. Stock specific, the stock has already given massive recovery in last 1.5 weeks from low levels. It has already broken out from its important support level. So from here on, we would expect a good move in MCX. 865 is our near-term target. It can be bought with a stop loss of 766. Apart from this, Sun TV, after long consolidation on Tuesday, we did see price volume breakout in this particular counter. On Wednesday, yes, the stock came off a bit, but we would rather interpret this as a good buying opportunity. Target would be around 725. It can be bought with a stop loss of 637.
All right. And what about you, Hadrien?
Yes, so both my calls are on the sell side. The first one is BEML October futures. We've actually seen a rising channel pattern breakdown on the smaller time frame charts, and even the other oscillators indicating that we could see further downfall for BEML. So I think one can short sell BEML October futures for a target of 570 and keep a stop loss at 598. Second sell call is on IRB Infra October futures. Again, the same scenario. The last 4 days gains has again seen a bearish engulfing pattern on the smaller time frame charts, even for the IRB Infra. I think one can short sell IRB for a target of 120 and placing a stop loss at 128.5.
Sharmila, just one last question on an Indiabulls housing finance before we let you go. I mean, Wednesday's session saw the stock moving down 13%. On the back of concerns regarding Supertech, but what's your sense right now with what's happening within the company and whether or not it's still, going to see a further downside from here?
Well, it seems to suggest that it will, not because I'm tracking the news very closely or it's a stock that I track particularly, but just going, by the news flow as well as the concerns that are mounting around this space. As we were discussing earlier, I think even the good names within that space have seen, have taken a beating. So I think it stands to reason that where there is concern, like you had concern starting from Diwan Housing Finance, now, you have this name mentioned. So, you really don't know where all this is going to take you. So as I said, I would just really wait and watch this for a while, and I do think, yes, that there is a greater possibility that you will see lower levels on these stocks.
Okay, Sharmila, we'll leave it at that. Thank you so much for taking the time out and joining us. Really appreciate your time this morning, and thanks for accommodating this last-minute request. That's Sharmila Joshi with her thoughts on specific names. By the way, I must say, what's starting off slightly weak and looking like starting off weak as we get ready, as the pre-open rates get ready to settle down, Mindtree 5.5% lower. And I was just looking at the numbers, looking at Agam's commentary as well. The numbers below estimates for sure. The stock trading at about 19 times FY20 expected EPS, TCS at about 21, 22. A bad quarter or a slight miss on quarters would definitely lead to stocks moving down, and that's likely to happen to Mindtree as well. So on a quarter-on-quarter basis, while there has been an uptick, it's slightly below estimates, and which is why stock likely to start off 5.5% lower. Sameet, some of the IT names post their numbers. Infosys was a different case, but TCS just about an inline quarter and got punished. We likely to see the same start to Mindtree, but is there a trade here?
See, this stock has been underperforming, in since last 3 to 4 weeks. It has, if we look at the daily chart, it has been maintaining its low top, low bottom structure. 1020 we were seeing as a major resistance level, and today with a gap down opening, 935 would be the level to watch out for. If the stock slides below 935, stays for a while below that level, then this stock can head towards 900. So I think one should wait and watch. 935 remains to be a very strong support. Below this, yes, one can go short for a target of 900.
Hadrien, if somebody had a long call on the cash side, of course, on a Den and a Hathway, are they looking toppish because they haven't quite made some exaggerated moves in the last 2 or 3 sessions and the news is now out? What would you do if you had bought it for this news and now that the news is out, they're looking a bit toppish?
Yeah, absolutely. Specifically, Den Networks is failing to surpass its long-term 200-day moving average that is close to the 76 mark. if you see Tuesday's top was around 80 rupees. So 80 is going to turn out to be a very important level to watch out for. 76 no doubt is the long-term moving average. If we see both these levels surpassing, then only I think we could see a good up move on then. Otherwise, if anybody has a long position, I think one should at least at the moment take money off the table.
Okay, minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Let's start off with earnings that will be reported today. UltraTech is the only Nifty company to report numbers and likely to start off 3% lower, while SBI Life Insurance Company and ICICI Securities are amongst the other important ones to come out with the results today.
Among earnings which came on Wednesday, Reliance Industries made street estimates aided by strong performance in their pet chem business. The Geo vertical was aided by strong subscriber additions.
And Reliance Industries continues their expansion plans in the cable and digital businesses. The company will buy 66% stake in Den Networks and 51.3% stake in Hathway Cables and make an open offer for additional stakes. The stocks starting off marginally higher.
Among other earnings reported over the holiday, disappointments came from ACC, Mindtree and Emphasis. On the other hand, Havells and DCB Bank reported stable numbers.
The Reserve Bank has refused to grant Rana Kapoor an extension as MD and CEO of Yes Bank. The regulator has asked the lender to find a successor to him by February 1, 2019.
And PTI has reported that Tata Group is in talks to acquire a stake in Jet Airways.
Okay, two large caps on which we needed some chart checks. Sameet, to you. Reliance Industries likely to start off 4% lower. Yes Bank after the 6% downtick. Another 2% downtick today. What do you do with these two names?
No, Reliance is, as far as Reliance is concerned, this stock has already corrected, from the levels of 1260 towards 1050, found some kind of support, and in last 1.5 week we did see some kind of respite. But going ahead, 1170, 1180 would be seen as major hurdle, and from there, on Wednesday we did see massive selling coming in. So this stock now would likely to trade in a range wherein on the low side 1050, 1040 would act as a support, and on the higher side 1180, 1190 seems to be very strong resistance. So as a short-term trader, any pullback towards 1140, 1150 according to us would be a good selling opportunity, and the stock can head towards 1050 or 1060 over the next few days. As far as Yes Bank is concerned, clearly the stock, if we look at the daily weekly chart, all looks quite weak. 250, 255 according to us would act as a very strong resistance, and the stock is now likely to slide towards 210, 205.
Okay. Hadrien, I want to ask you about the Jubilant FoodWorks. The stock has come off from its highs of about 1564 in the month of August to closer to about 1150 odd. Is it an opportune time to look at this stock right now after the correction?
No, actually, if you see the daily charts, first of all, again, a lot of stocks that are actually following the same thing, they're failing to surpass its long-term 200-day moving average. Secondly, it is continuing to maintain its lower top, lower bottom structure. The rally that we've seen in the recent past, we are seeing some kind of failure in terms of extending the momentum that we were expecting. So I think, again, this rally should be taken as an opportunity to trim your long positions, or be a little cautious on the long side, because I think if we see the low of 1180 being broken on a closing basis, I think further downside could be, quite possible for Jubilant FoodWorks.
All right, Jubilant FoodWorks still not managed to breach its 200-day moving average yet on the upside. The other one is TCS, and we've been talking about how TCS has been in the recent past, at least in the last 1 year, taking support at its 100-day moving average. Right now, it's still trading under it, not managed to breach it on the upside. But Sameet, quick word on TCS?
See, with the near-term view, we are not so upbeat on TCS. Weekly, monthly chart still looks quite negative, and weekly chart has already seen a bearish engulfing pattern a couple of weeks back. Stock has corrected substantially over the past couple of weeks, but we still believe that any pullback toward 2000, 2030 is likely to get sold into.
10 seconds each, your top calls for the day. I'll keep it with you, Sameet.
It would remain MCX. The stock has been outperforming, so we would go with MCX. It is likely to head higher, wherein our immediate target would be somewhere around 865, stop loss at 766.
Hadrien, quickly.
Yeah, Indian Bank, one can short sell for a target of 216, keeping a stop loss at 230.
Okay, Jaman, just stay on. We'll take in opening thoughts for you post-market open because the index is likely to start off slightly weak, so would be important to get in your opening thoughts post-market open. But here's how the markets are starting off this Friday morning. Not too good, I'm afraid. About 1% lower, at least on the Nifty. And let's see if it worsens further. In fact, 1.25% now on the Nifty on open, 1.35%. It's not the Bank Nifty which is leading the charge, and not surprising, we'll get the movers up on the screen. Reliance Industries falling would lead to some carnage on the benchmark indices. But just bring up the mid caps and the small caps once very quickly before we get the heat map, and some downticks out there too, not surprising at all. Let's get the heat map, and Reliance Industries should be somewhere here, should be amongst the top losers on the index. It is 6% down. Again, the trend continues. Large caps, which are not just about meeting estimates, are getting beaten out of shape. Reliance Industries down 6%. Indiabulls Housing continues to fall off. Yes Bank, so 6% in Wednesday session, 4% today, and now near about those levels that I think Sameet Chavan was talking about. UltraTech Cement, in anticipation of what the realizations could be, because if ACC's realizations were not that strong, maybe the whole pack will not have good realizations too. So out of the numbers, UltraTech Cement grinds lower. Infosys corrects too. But the moot point is that there's a fair bit of red on the screen, very little green. What is in the green? Let's try and figure that out. No heavyweights that I can spot. Bharti Infra, that's been all over the place. On a good day, Bharti Infra corrects. On a bad day for the markets, people see some buying there. So ignore that one. HPCL, IOC marginally better because crude has cooled off a little bit over the last couple of sessions, ever so marginally I might add. And Maruti, which slipped below the 7,000 mark, is seeing some bit of buying right now. But aside of that, a fair bit of correction. Indiabulls Housing Finance now about 7% lower, and I dare say stocks like Divan, etc. too could be getting beaten out of shape. I'm sure Devin will bring all of those up, but just keep in mind there's a fair bit of pressure on the screen, and the big boy Reliance Industries is correcting. Reliance and Infosys between them should be the top two contributors. Add to that a TCS, so IT is not having a good day either. Let's talk about some reactions before I hand it over to Devina for what's happening at the broader end of the spectrum. Some result reactions and some stocks that could be in news in the session today. So Den and Hathway, Reliance's new buys, and as we were talking about, Den Networks surpassing, not failing to cross over its key moving averages and correcting today. Hathway 5% higher. The open offer price could be somewhere around 32. The stake purchases are on that price too. Seeing some marginal upticks right now. Let's see how long does this last. What about result reactions? So Emphasis, Mindtree and Cyient, and clearly to my mind, while Reliance is the large cap mover of the day, Mindtree at the broader end of the spectrum is probably the stock of the morning. 9% down for this one. Expensive valuations, results just about okay. Well, the stock getting beaten down. Last but not the least, since we're talking about results, let's bring up two others. Havells as well as DCB. Muted reactions compared to what we've just seen. But yeah, Havells correcting ever so marginally. The margins were a bit off. And DCB, the numbers looked okay, marginally higher in trade. What are you spotting there?
Well, starting off with a few movers on the NBFC side. Divan Housing is down about 5.5%. Repco Home Finance was a loser on Wednesday session. Continues its lower grind. It's down about 5% right now as well. From the real estate pack, it's the Indiabulls real estate, which is down about 6.5%. You've got the likes of a Vakrangi down 5%, and 8K Miles. We've been talking about how that stock, we spoke to the management as well on Wednesday. The stock was down on lower circuit on Wednesday session. Today as well, it's down on lower circuit. RLNFS Transport is down 4%. You've got a stock like VIP Industries. Saw an initial uptick at the start of the week, but then once again the pressure's building up around the counter. It's down in the session today. Ambuja Cements is down to 2.5%. L&T Info is down about 3% but Mindtree now is down a heavy 10%, so it's at 880, and you are seeing a heavy build-up of pressure there. Avanti Feeds is down 4%. Den Networks has continued its move down. Rain Industries is down 4% as well. The market breadth looks extremely thin right now, obviously bent more towards the negative side, but GVK Power is down 4% in the session. Some of the other PSU banks also are looking weak. Godrej Consumer, Dish TV, these are stocks that are losing out in the session this morning. However, just to highlight a few gainers, Jet Airways, with the interest that's coming in from Tata Sons, the stock's moved up 7.5%. Remember, nonetheless, it's a very beaten down name, and you are seeing a little bit of respite coming in there. And alongside that, an Interglobe Aviation also picks up about 2.7%. Reliance Infra is up 2%. You've got the likes of Cyient, which is up 1.2%, and an M&M Financials does okay for itself, 1.5% higher.
Okay. But just before we get in, our next fundamental guest, Harsha Upadhyaya, should be with us any moment. Just quick thoughts from Sameet and Hadrien before we thank them. Sameet, to you first. About 1% lower on the index. Anything that pops up on your screen, any observations?
No, as I said, markets do not have sufficient strength to go down now from here. 10,200 according to us would act as a very strong support, and before that for the day 10,280, 10,300 would be seen as immediate support. So as I said, if market stabilizes for another half an hour, 1 hour around those levels, then we would certainly take contra longs around those levels, keeping a stop loss around 10,240, and we would expect some kind of respite coming in the second half.
Interesting. Hadrien, how are you approaching trade today?
Yeah, I'll be a little more stock specific, and I think Shriram Transport Finance, continues to remain weak. After that bearish engulfing, we have seen a follow-up sell-off in Shriram Transport. I think we could see further downside, and I'm expecting Shriram Transport, to quote around 950, 960 levels. That should be the target on the downside.
All right, gentlemen, thanks very much. We leave it at that. Hadrien as well as Sameet, thank you so much for joining in. Another important market voice, Harsha Upadhyaya, CIO-Equity at Kotak Mahindra AMC. He's joining us on the show right now. Harsha, good morning to you, and thanks very much for speaking with us. What have you been making out in terms of how the market is looking to you structurally? I mean, while there are individual pain points, and you can see that in the form of NBFCs and the pressures that's building up around there are specific stocks which have come off their heady valuations as well. How are you positioning yourself?
Good morning. We continue to remain on the cautious side, as we were pointing out in our earlier interactions as well. The valuations were kind of higher than what we were comfortable at, whereas the macro headwinds continue to worry us. And it so happened that in the month of September and post that, we have seen most of these macro headwinds worsening further. For example, crude reached a level of $85 to a barrel. We saw currency depreciating and remaining volatile. We have seen 10-year yields inching up. So all of these factors contributed to nervousness in the market. And we also had the credit default event at ILNFS, which kind of spooked the markets. After that, we have seen a very sharp correction, but nevertheless, the valuations still remain on the higher side, except for the small cap basket. And we do not think that the small caps can move without the large cap or the mainline indices performing. So to that extent, for us, it could be a buying opportunity selectively in some of the mid and small cap stocks at this point of time. But from an overall market perspective, we continue to remain cautious, as we have not seen any of the macro headwinds kind of reversing and being supportive at this point of time.
While, you did mention that you look at the good quality names, it's quite a reversal from what we've actually seen that happened in 2017 versus what's happening in 2018, where the smaller and mid-cap names last year were the ones that garnered a lot of flavor, and there was a lot of interest in them. And there's a complete reversal of that that's happening here. We've seen a shave off of almost 40% in the mid-cap index. How did you read into this kind of a divergence within the mid-caps and the large caps right now?
See, clearly, whenever there is a market correction, the most over-owned stocks take a hit, and that's what is happening. And we had seen a large rally, both in terms of price as well as time in mid and small caps for almost about 3.5 years. And also index had seen quite a bit of up move. Now that is getting corrected, because whenever you see macro headwinds, the negative impact of those challenges would be more severe on the smaller set of companies rather than the leaders in each of those industries. So to that extent, there is some fundamental negative that is impacting mid and small caps. And also the fact that these were one of the most sought after and most owned stocks across portfolios. We have seen some of these correcting simply based on the selling. Either could be through redemptions or through profit booking. And as always, every correction, even the good stocks with strong fundamentals will decline. And that is where I think portfolio managers will have an opportunity to bet on some of them if they believe that the price fall has been more than what the fundamentals warrant at this point of time. And that's what we are trying to do in our portfolios as well. While remaining cautious, we are looking at some of these names where we could build our positions over the next 2-3 quarters.
Harsha, good morning. Neeraj here. Just to understand, have equity flows stayed stable the first 20 days of October?
Yes, Neeraj. There has not been much of a change in equity flows at this point of time. Yes, compared to the beginning of the year, there is quite a bit of moderation. In the beginning of the year, we were seeing about 18 to 20,000 crores of net equity inflows into mutual fund industry, and that number had gone down to about 8 to 10,000 crore level in the last couple of months. And seems like even October that trend would continue, although it's mid of the month, but until now we haven't seen any large change in that flow.
Just before I come to the market question, Harsha, I mean, the fear was at the end of September when the figures were all over the place, that October might see an encore on the liquid side, or if not an encore, there could be some turbulence there, but equity flows too could slow down and maybe the net flows, non-SIP could be negative. As of now, as things stand right now, you don't foresee that, if not for the industry, then at least for your funds.
Neeraj, I really do not have an idea about the overall industry numbers for the month of October.
But for your funds?
As far as our funds are concerned, and I would take it as a barometer for the market, we really haven't seen any significant change in terms of the overall flows. Okay. So that makes me believe that even October should be more or less similar to August and September.
Well, that's actually good news. Harsha, thanks for that update. Now, Harsha, coming into some of the usual suspects, and just wanted your opinion here. Today, RBI has come out with some more easing of liquidity measures for the non-infra lending NBFCs. So the pocket is in the eye of a storm, but some measures being taken. How are you positioned here as of now, and how are you approaching fresh investments, if at all, within this bucket?
We were underweight on the NBFC and the housing finance sector largely across our portfolios, and that positioning still continues. Our belief is there is some amount of liquidity pressure on the NBFCs at this point of time, which will get corrected over a period of time. The recent RBI dispensation is also a move towards that. While that is happening, we don't really see the stock performance really being better than the market performance in the NBFC sector, simply because the valuations are still on the higher side. So to that extent, we will continue to remain underweight on the sector. And the couple of NBFC names that we have in our portfolio are all very good quality names, where the asset side, there is absolutely no issue. The quality of the book is very, very strong. And also they have been one of the players where there has been a granular improvement in terms of the overall diversification that they've done on their overall book. And some of these players are top rated players where while the cost of funding could move up for the entire sector, we do not see any pressure building on it, in terms of liquidity for these players at least. And we also believe that the pricing power is going to be there in some of these players where the business is very strong, and hence that would get passed on. So continue to remain invested in one or two names that we have in our portfolio, but otherwise largely underweight on the NBFC sector.
Harsha, any significant rejig or rebalancing in the portfolio that one could probably undertake right now?
We believe that at some level the discretionary consumer demand could get affected over the next few quarters, especially post the festival season. A reason being there has been a significant hole in the pockets of consumers who have paid higher prices for petroleum products. And also we have seen NBFCs at some level cutting the easy credit that was available to discretionary consumption. And the developments that have been taking place in the NBFC sector will make sure that the credit growth is more normalized rather than the aggressive kind of lending that happened over the last 6 or 8 quarters. So both these factors put together, and the fact that discretionary consumption in the country has grown at very, very strong levels over the last 3-4 years, we could see some tapering of demand there, and that's what we are concerned about. And accordingly, we have reduced our exposure to autos and consumer durables across our portfolios.
Okay, Harsha, just before we wrap up, the IT, the rupee beneficiaries, so to say, not necessarily only because of that, but IT and pharma, a bit of a rally from those lows. Now we're seeing signs of a slight miss on the quarterly numbers and stocks getting beaten down. We saw that happening with TCS. We're today seeing that happening with Mindtree as well. How are you viewing the IT pocket currently?
I think at least a section of the market believe that the rupee tailwind will be visible in the September quarter results for most of the IT companies. But clearly, none of the companies will keep all their revenues unhedged, so there will be hedging. So the real improvement in terms of margins would come with a lag of couple of quarters. But otherwise, I think the business momentum has remained strong. We have seen BFSI and retail verticals really showing strong demand across players. And we have also seen some of the large deal wins taking place, and also the pace of deal wins have improved. So given all this and the overall outlook on the market, which is still cautious, I would believe that IT and other export-oriented sectors, or those sectors which gain when local currency depreciates, would be the ones where there would be some hiding space in this kind of volatile market.
All right. Harsha, we'll leave it at that. Thanks so very much for joining us on this conversation. Appreciate your time. A quick look at the markets then. For the Nifty as well as the Sensex, we seem to have come off the lows, but still a cut-off closer to about 0.8% or so. So Nifty there at 10,350. Sensex down about 1% as well at 34,462.
Yeah, just one stock that I think we had marked today, ACC, and that miss on realizations leading to the stock coming off quite rapidly, about 8% lower now for ACC, 1419 and counting. So do keep the cement names at the back of your mind. Might not be a happy quarter. But let's take a break. On that note, on the other side of the break, the grocery space in India undergoing a transformation, literally, especially with online players like Amazon Pantry and Big Basket making their mark, and Avenue Supermarts feeling the pressure of margins as well. So what does it mean for all of these incumbents like Future Retail and Avenue Supermarts? We talked to Joint MD Rakesh Biyani on the other side.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but पॉलिसी समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Back with Indian Open right here on Bloomberg Quint. The pressure on the equity markets continues, about 1% lower for the benchmark indices. The Nifty Bank not falling as much, and which points towards IT and Reliance being the key culprits for taking the index lower. The Nifty Bank incidentally slipped into the green for a minute, actually went into the green for a minute before coming off as well. But the pressure continues. Nifty IT down, Reliance Industries down. However, the discussion at hand, and that's on retail. Now, Big Basket and Amazon Pantry are just some of the online players which have slowly but surely managed to carve out a small space for themselves in this Indian grocery space as well. Innovative delivery solutions and discounts have only made it more competitive for all players in the market. Add to that, Avenue Supermarts saying that they had to resort to some bit of discounts in order to maintain the market share. So, how is Future Retail, which operates stores like Big Bazaar, KB Fair Price and Food Hall, coping with all of these new offers? Let's ask the company's Joint Managing Director Rakesh Biyani this question, not just for Future Retail but for the industry at large. Rakesh, so good having you. Thanks so much for joining in. Off the bat, are you seeing some stress in order to maintain market share and margins, or is it specific to specific players?
No, I think overall the market has sort of grown quite well. For us, the market share has increased. As per Nielsen data, we have seen a significant increase in a lot of markets in terms of the share of sales from our store. So that's quite encouraging. And I think the way one has approached it, for us also, we've been sort of, this April we rolled out Hadrien lowest price as a strategy, which is basically the everyday low price, and where we are guaranteeing that we would have the lowest price in the marketplace, and that's moving out very well. We've been sort of tracking our prices, and we're quite confident that we are able to match the lowest price or are actually lower than many other retailers across product categories. And I think the customer is recognizing that, so the share of sales out of our stores have been quite strong. But I think overall, anyway, the market has also sort of expanded. To say that the market is not expanding, it's not true. There's a lot of space for many more players. It's a very large market. A very small portion of that is organized today. So I think we're quite buoyant in terms of the way the market is likely to play out. And for us, our strategy to ensure the fact that we get a larger share of the market is to continue with the large format stores like Big Bazaar, and at the same time supplement them with a chain of Easy Day stores, which is also rapidly expanding, and we believe the fact that over the next 2 to 3 years we should be able to see a significant amount of expansion in that space.
Rakesh, good morning, Devina here. I mean, over the past decade, we've always seen that, the organized retail sector has an 8% holding versus the unorganized retail segment, which is about 92% of the market. Is that likely to change, according to you, anytime soon? And then if you add to the mix e-tailing and how, the likes of an Amazon pantry are coming in to take the market share away, is that a significant threat?
See, I think when you look at the fact that, just about 6 years back, what is at 8% today was at 2%. So I'm assuming the fact that, that 8% number will soon become 10 and then 12. But in the near future, I see the fact that the number is likely to be between 15 and 20. And that's going to be coming out from a large share of the new stores, new expansion that will happen, or the expansion in the marketplace that will take place. Organized retail could get a larger share of that. And the size itself is too large. So, and when you look at the scale of business that each of us are doing, or the incumbent players or the new players are likely to do, there's space for everybody. It's not that Amazon will come in or anybody else comes in, replaces somebody else. I think it's just, taking in shares out of taking in shares out of the new market that is getting created. That's the larger theme here. And I think that the process is a bit slow, and which is fine, where the share of organized trade as a part of the total trade from 8, ultimately I would say the fact that 20 is a good number over the next decade, and that would make the organized retail industry a very, very large player from what it is today.
Rakesh, just to follow up to that, there's a Deloitte report which suggests that by 2021 there will be 650 million internet users in India. I mean, obviously, when that statistics increases and the kind of offers and deals and the competitiveness within the e-commerce space in your particular area itself will likely mean that your general mode of shopping, which used to happen and that you say right now is your market, will sort of become less competitive. How will you tackle that?
I think it is unfair to think that the deals and the excitement is only in the online space. There is even far better deals, far better value. And of course, there's a touch and feel. What you see is what you buy, and that's what goes with you to home in your shopping cart. That is what the offline offers, and there are many of these things which may be not necessarily easy to do in an online space. So I think it's a misunderstanding. Understanding itself is wrong, which says that the deals and the excitement only lies in the online space. Offline is as efficient, offline is as vibrant, and provides an outstanding experience for the consumer. And that's what, and at the end of the day, consumers want to touch, feel, and be sure about what is it that they are seeing, and that's exactly what they are taking back home. That necessarily does not happen only in the online space. Now, yes, in the online space, the advantages could be the fact that the assortment could be very large, the choice could be very large, but at times, I think customer doesn't want to see so many choices also, because it makes it that much more difficult to make a decision. So there are pluses and minuses. There are going to be customers who are going to be happy buying only online, and there are going to be a lot more customers who are going to be happy buying offline. And so there's market for all players, and that's what the rest of the world is showing. Despite online being there for about 20-25 years, retail stores have not shut down. Retail stores continue to be there and continue to grow in majority of the markets in the world. In the most advanced markets of the world, only 20% of the business is currently happening. On the outer limit, I would say, is 20% of the business is happening online. 80% of the business continues to be in an offline space, and I see India not being any different from any other parts of the world.
Okay, what's the current experience? This is how I started off my questioning with Rakesh. So if you look at two results that have come out thus far, and that's the benchmark that we have, Avenue Supermarts and Reliance Retail. Avenue Supermarts management highlighted price cuts undertaken across categories to ensure more value to customers. Now, I would read this as a sign of forsaking or foregoing some margins in order to maintain market share /sales /customers. Have you had to do the same as well? Is it an industry-wide phenomenon, or is it specific to one company?
I think, for us, when you look at our concept, specifically, let's look at a Big Bazaar. Big Bazaar is truly a multi-category retailer. There's a great balance between the grocery and the non-grocery categories. We have a very large share of sales out of fashion and home products, and an equal share of sales coming out of grocery. So for us, the basket is extremely well managed, and our margins have continued to be quite strong. We still are using centralized distribution. We have built a lot of private brands, and combine all of these efforts, we are able to deliver a lot more efficiencies as we keep moving forward. GST was a key enabler to build towards efficiency, and I think that work is still on. So while we're very competitive in the market space, we are guaranteeing that on the groceries, the prices at Big Bazaar are the lowest. Consumers are assured of it through our Future Pay app, where you can sort of do a price match. And if there is any place where we are not competing, we are paying back the difference to the customer. So that's the kind of assurance model we have been doing, and all of that is reflected in the margin model that has got delivered, which is becoming actually a quite healthier and healthier margin model.
All right. Just one last question before we let you go, Mr. Biyani. Regarding some reports of Amazon being interested in picking up stake in Future Retail. If you can give us your take on this.
See, I think we are a large retailer. There are a lot of players in the marketplace. There's always very interesting discussions that keep happening around one specific area which one is seeing emerging across the rest of the world, where there is a convergence which is taking place between an online and offline retailers. And that's an interesting space that's of interest to us also. So rest, I would say the fact that as and when if there is something which is provides a strategic better value to our stakeholders, we will definitely be going back to our board with the proposition and seek an approval to
Has there been any initial interest as well, just from Amazon? If you could just put that into perspective.
So as I said, it's a very interesting space today, and it's not only in India but across the world that's happening, and that's something which is keeping us interested also. We also want to sort of keep evaluating what the proposition can get created, and if we do believe that it's going to add value to our stakeholders, we will definitely go back with a proposition to our board.
Do you see something like this? Not necessarily Amazon, Rakesh. Just one last question, really. But do you see a tie-up of this nature? I mean, the exact modalities may be completely different. It may not happen as well. But do you see a tie-up of this nature adding value to a player like you?
As I said, this is something which seems to be happening across the world, which is a convergence of offline and online. And in other words, it was also known as omni-channel play. So it's a new industry. There are a lot of new developments which are happening. We are sort of tracking exactly what's happening in many other parts of the world, how the business models are converging, what are the value that they bring, and we are very keen to serve the Indian customers. We definitely need to be relevant to the Indian customers at all the time, and thus we are evaluating all kinds of options which says as to what would be the next set of retail models that will keep our concepts more relevant in the long run, and that's one direction that we will always be focused on.
Okay, Rakesh, really appreciate you joining us and throwing some light on what's happening in the industry. More importantly, we look forward to talk to you post your results as well. Thank you so much for talking to us today.
Okay, right, bye-bye.
That's Rakesh Biyani of Future Retail talking about they're not seeing any significant margin pressure. Reliance Industries too didn't see. Speaking of Reliance Industries, it's expanding its presence in the cable and the DTH segment by acquiring controlling stakes in Den Networks as well as Hathway. Sameet Sarkar managed to speak to RC Venkateish, the former CEO of Dish TV, to get an industry perspective and begin by asking him about the impact of this move on the existing DTH players. Listen in to a small slice of that conversation.
The cable industry was ripe for consolidation because it's always been historically a highly fragmented industry, and even the bigger players who have been operating in this market haven't been actually able to generate the level of scale which is required to sustain the kind of investments which are required with the rapidly changing technologies, etc. However, having said that, I think this will still remain a route for Reliance to reach the homes in cable and convert them probably going forward into gigafiber-based technologies and things like that. In the immediate term, I do not see any impact of this on DTH because basically I think the first focus of Reliance will be to acquire these homes through the access that they have now got with the cable acquisition, and then look to upgrade those lines from coaxial to fiber. And I think that will be the primary focus, and that's probably the rationale behind this acquisition is more to get a route to the last mile connectivity via gigafiber rather than expanding a coaxial network, which is anyway, I think their plan, if you look at it from a geo perspective, would be potentially to give broadband as well as rich media as well as voice and all of that bundled together, and their focus will be on these homes rather than the DTH homes at this stage.
But sir, we know that Reliance Industries has stated his claim that he wants around 5 crore subscribers. So eventually there would be some impact on the DTH segment because of this consolidation in the cable market?
Not really, because as you see, the DTH segment caters to, even in the US, it caters to the widely dispersed geographical areas. Even today in the US, you have a fairly substantial subscriber count, which is DTH, despite the fact that you have very strong cable players like Comcast and Time Warner Cable, etc. So I don't see any immediate impact, but certainly, yes, in a longer time frame, 3 to 5 years, there could be some impact going forward because obviously the pipe is a much better pipe. Optic fiber pipe will allow for two-way interactivity and things like that, which is a bit of a challenge for DTH because it's a one-way pipe. Having said that, however, the satellite technology is a very efficient means of delivery and very cost-efficient means of delivery because the bandwidth costs which are associated with any of these land-based technologies are substantially higher than those of a satellite operator. So we do expect that, over time, perhaps the dense urban agglomerations like the main cities, Bombay, Delhi, etc., would be ripe for conversion. And to that extent, I think that DTH could face a bit of a challenge there. But in the rural hinterland and other places in the far-flung areas, DTH, I think, will not be immediately impacted.
And do you expect price wars to intensify further between the DTH players and the cable players post this acquisition?
If I read whatever I'm reading correctly, this is going to be more of a bundled offering where you have X amount of bandwidth, you have TV, you have voice, everything bundled together in a single monthly subscription. So and whereas DTH is a pure play, content delivery system. So I don't see that there's going to be escalation of price. If anything, I think this also is a positive for ARPUs because one of the reasons why ARPUs are not moving up in the entire industry was because of a fragmented cable. But if there's consolidation in cable, Reliance will be very well placed to actually increase its prices. And if it does that, it will benefit the entire industry as a whole.
But then what about the DTH segments, sir? Do you expect them to lower their prices if there's a price war?
No, that's precisely what I'm saying. The product they're selling are different. DTH is selling a pure play TV segment, whereas if we yet to see that, but my guess is if whenever Reliance Jio comes out, Gigafiber comes out, it'll come with a bundled package for a monthly subscription, which will be substantially higher than what the DTH players currently offering, because they'll be offering TV as well as broadband as well as voice and a whole suite of offerings that they put together. I don't see them pricing it at DTH levels. So I don't think price is the determinant here, unlike Telecom, where the game was very different. It was a game of capacity utilization rather than content delivery. Content delivery is associated with costs. Therefore, I don't believe that price is going to be the basic motivation.
But sir, don't you think that consumers would prefer a service provider who's offering you broadband and DTH both rather than being into two different subscribers, one with DTH and one with broadband?
Yeah, but I mean, if you already have installed subscription, then you're happy with it. There's no immediate motivation for change. So, and remember, there are other players also who will participate in the broadband. They will also come up with offerings. The telcos also interested to be invested in the space. There's plenty of other broadband players who also will hold on to their subscribers. So it's a market dynamic. We'll have to wait and watch. But as I said, I don't see any immediate catastrophe for DTH or any such thing, the way the market has been pricing it.
So you still expect that customer stickiness could be an issue for Reliance Industries even post this acquisition?
Customer stickiness for Reliance in what sense? Because they don't, or they haven't
usually in the broadband and DTH segment, we have seen that customers don't tend to change operators that frequently as we have seen in the telecom market. So do you think that will still pose an issue for Reliance Industries?
Yeah, it is because, changing a SIM card takes you 5 minutes, whereas changing a connection to the home requires fairly significant investment in terms of time and getting somebody to come and wire up your home and things like that. So there will be that inertia factor. But at the end of the day, if the service is really good, then it's only a question of differential in terms of time. It probably take a little longer time, but if the service is superior, then people will opt for it. But, you know, we haven't seen the packages, we haven't seen what exactly is on offer, so I think we'll have more clarity after they announce all the various packages and things that they have planned.
So earlier when Reliance Industries had announced its entry into this segment, we all knew that last mile connectivity would be a major issue for Reliance Industries. Now post this acquisition, do you still think there would be some issues with this last mile connectivity, or this issue is now completely resolved for Reliance Industries?
No, I think at least as far as these 20 million homes are concerned, the last mile connectivity issue will probably mostly resolved, right, through this acquisition. The challenges ultimately beyond the first 20 million, or they might probably acquire more cable network, and then there's a limit to which they can do that without triggering CCI's intervention. So we'll have to see, but this gives them a jump start. You know, it gives them the first 20 million homes to which to have an easy route to the last mile. So it's a great move from a perspective of getting this business started off. It immediately gives them access to 20 million homes, which is great. And then, of course, they will be planning out what next. So not really in a position to comment on what their thinking is on that.
Lastly, sir, you have been in this sector for a very long time. So according to you, now post this acquisition, what could be the major hindrances for Reliance Industries going forward?
Well, Reliance is well cashed up to pursue a project of this magnitude. Immediately they have the fiber backbone on which they've been working on it for years. So pretty much I think they're in a pole position. I don't think there are very many people who can challenge them on this at this point. Either this requires both infrastructure as well as a very strong balance sheet. And, you know, even if others have the balance sheet, they probably don't have the access to the infrastructure which is required. So I think they're in a great position.
Also, sir, the DTH segment is a 5-player market as of now. So are you expecting some consolidation to happen further in this segment because of this move of Reliance Industries?
Yeah, I think further consolidation is certainly a possibility there. As said, already seen one round of consolidation with Dish TV and Videocon. We've also seen Airtel parceling out a small stake to Warburg Pincus. Tata Sky is the other major player. And Sun is very localized to the south. So yes, certainly I think there is possibility of further consolidation.
So what would be the appropriate market size of this player, of this industry? 2-player, 3-player? How many players could be the right?
No such thing as an appropriate market size, but certainly, I mean, if Sun is a regional play, it's unlikely that they will consolidate, because I think one of the primary reasons why they are there in that market is to protect their broadcast business. So that leaves Airtel and Tata, and I wouldn't be surprised if at some point the two of them got together. But this is pure speculation. I have no knowledge about that.
Well, that's an important voice dissecting what will happen to the space at large. R.C. Venkateish, former Tata Sky, former Dish TV. Okay, we're just about done on the show. Remember, the markets are down about 1%, so just about at the levels that they started off with, 1% lower for the Nifty and the Sensex and 0.5% for the Bank Nifty. But all the action will be taken forward by the FNO show. Thanks so much for watching Indian Open from Devi and me and the team that put this show together.